Welcome to FSC Baradine Video Magazine, Volume 1, Number 2. This was compiled June 21st, first day of spring 2014. It is entitled Trading Baradine Signal. FSC Baradine is evolving disruptive technology for traders. The following slides of our internal Baradine price studies demonstrate vividly what we now have come to believe and understand to be a discovery of an unknown signal of an unknown origin, possibly it would argue something out there. The results of this current research provide at the very least preliminary and compelling empirical evidence of the possibility of a planetary control mechanism of the equity markets, if not of all FSC cyclic recorded phenomena from 1941 to the present. The seeds of disruption can be planted sometimes very subtly. This is a picture of the Tandy Radio Shack TRS-80, which was born on August 3rd, 1977. It was the world's first popular priced PC. IBM units were selling for as much as $5,000 and up. This was priced at $599. I began this journey to disruption in April of 1971, over 43 years ago, on a Texas Instruments handheld calculator in San Antonio, Texas. I started computerizing my journey to this disruptive technology with the purchase of the very first TRS-80 sold in San Antonio, Texas on August 3rd, 1977. The birthplace of this research, as well as my own father's birthplace, for $599 plus tax. Actually, that was $2,343.34 in today's dollars. That was cheap, as I said, for a personal computer back then. From the first video, I have received a question. It says, I've watched your first video magazine twice. It leaves me with some problems. I see these interesting comparisons over time periods, but they are in the past. Using them to trade, a person has to think where they would go in the future. I see, though, that one could wait until a trend seems to have developed and then invest. And those good matches are for selected periods. I notice that at other times there may be no correlation, or it may be inverse. I suppose that, again, the trick is to wait for a trend to start. Any ideas on how one could handle these? The answer is this. Baradine always documents the price signal 1 to 2 years in advance. The signal is not back-tested, but rather precast into the future, based upon current planetary paths along others that we have already cataloged based on historical responses. We all know that the Earth's year is 365 days for 3 years, and then there is a fourth year that is 366 days. We all know this. We use the same type of documented known data points in our signal based on the very first trade of the asset we're looking at. The Baradine signal is shown in red in the videos. We show a moving average of the signal in black before the year begins. We make future trade decisions based on our collective opinions twice a week, and these meetings are recorded, and I would encourage you to review 1 month's worth of recordings to better understand how we have used them in the past. Inversions or mirror images happen approximately 15% of the time in the average, and we are working diligently to reduce our need to interpolate these events. One of the most important aspects of the work is that we are showing the timing and direction of the signal. The price variation is not a part of the precast, although the black line, properly synced, does pre-shadow the price line, as is seen. Price signal generation and trade deployment. We have designed custom software proactively and periodically revising. We have an empirically derived proactive methodology applied. The signal to price catalogs are continuously developed and updated, and we have live meetings twice weekly to navigate the live signal and recommend trades, entry, and exit dates. Software. To generate the data needed to support and investigate the hypothesis of a live price signal, software needed to be developed in-house with specific functions. The 2 modules developed were named CCRS and CPM. The methodology of using the software follows. Methodology Part 1. Determine the date, time, and place of the first trade. Acquire the asset close price history. Remove, for forward walk testing, the recent close prices, typically 2 years of the most recent prices, to validate the forecasted output signal. Run the CCRS module to output historical and future planetary positions files. Import and run the planet-based angle to price momentum study in the CPM module. Part 2 methodology. Import the separate Mercury, Venus, Mars CPM module momentum forecasts outputs into Excel. Add the rate of change forecast values for each planet into final composite Mercury, Venus, Mars total forecast value. Invert the Mercury, Venus, Mars to produce secondary mirrored values. Graph in Excel the date, close, Mercury, Venus, Mars total rate of change output. Then add a 5-day simple moving average trend line of this Mercury, Venus, Mars rate of change forecasted output in Excel to produce the precasted, retrended future price line. Part 3, we have some protocols. The first trade date is preferably the first date on which the asset under study was first offered for sale on the current exchange traded. The first cash trade date is used as a matter of protocol to establish the forecasted price line of the cash underlying for convenient application of derivative trade dates for futures, options, and ETFs. The time of first trade is usually the open of the market on the first trade date. Use the market's longitude, original location, longitude, and latitude if different from the current location of the market. Here's a sample of the close price history in Excel. This is the Dow. Typically, we remove the most recent 2 years of price history from the run to enable visual graphic inspection of the validity of the output future forecast model. So typically, there is no price data in any models that we project or show for 2 years ahead based on this protocol. The CCRS run generates one file with the Mercury, Venus, Mars historical and future planetary positions, calculated typically from the date of the first available close price. These positions are not the typical positions used by any financial astro person or company as far as we know, because they're based on proprietary discovery of what I call a sweet spot that has nothing to do with anything I've seen outside of our work. The CPM forecast run, the CPM optimal run settings and outputs have been determined empirically from observation of the precasted price line behavior across the 15 different main original Baradine assets since September 27th of 2012. You can see here the 3 expected rate of change outputs in terms of the data columns, Mercury, the Venus, the Mars, and the summation in columns O and P. Here's some visuals of the in-house Baradine software we use for this work. Let's look at some premise disruption. A disruptive technology is designed to disrupt premises. The first premise we're trying to disrupt here is the future is unknowable. Well, I have to ask myself, if the future is unknowable, isn't trading pretty much the same thing as gambling? Here's a brief article excerpt from the Huffington Post. The author says there are subtle distinctions. Without the creation of cash settlement, a historic advancement of the development of financial futures, as would not have been possible to launch stock indexes or euro-dollar interest rate futures without it. It was very much in doubt because previous court challenges trying to restrict futures trading based on gambling laws were defeated because futures markets contemplated delivery. Physical delivery is the only thing that kept futures from being outlawed as gambling at one point. Interesting. This author says he has no problem with the connection of trading to gambling because both involve taking risk, and in both you can improve your chances with solid research and risk management. He says, I also worked on the floor for more than a decade and knew that many traders would refer to positions as bets and often weren't adverse to making a wager on just about anything if it had more to do with the type of personality that enjoys the action. And Blair Hall, a famous options trader who sold his market-making business to Goldman Sachs, began his career counting cards in Las Vegas. Well, let's see what kind of disruption we can create here. This is an actual picture of the Dow Jones 30 precast on 7/10 of 2012. This is a picture of the actual close of the Dow 30 on a calendar date of 5/6/2013. In other words, if you're in Baradine on 7/10 of 2012, you would have had this picture in front of you, projecting from 7/10 of 2012 all the way through 5 of 2013. This is what the Dow actual close looked like on 5/6 of 2013. Is it possible the unknowable Dow Jones future was revealed in advance? If so, premise one, the future is unknowable, is being disrupted. Perhaps the future is not completely unknowable anymore. Premise two, risk management. Risk management is an essential but often overlooked prerequisite to successful active trading. This is from Investopedia. After all, a trader who has generated substantial profits over his or her lifetime can lose it all in just one or two bad trades if proper risk management isn't employed. I think to myself, what about intelligent position sizing? This article will discuss some simple strategies that can be used to protect your trading profits. Planning your trades. As Chinese military general Sun Tzu famously said, every battle is won before it is fought. The phrase implies that planning and strategy, not the battle, wins wars. Similarly, successful traders commonly quote the phrase, plan the trade and trade the plan. Just like in war, planning ahead can often mean the difference between success and failure. Stop loss and take profit points represent two key ways in which traders can plan ahead when trading. Successful traders know what price they're willing to pay and what price they're willing to sell, and they measure the resulting returns against the probability of the stock hitting their goals. If the adjusted return is high enough, then they execute the trade. Let's look here at the previous picture of the Dow. We're sitting back on 7/10 of 2012. This picture in front of us, we're in a time machine. We're actually back on 7/10 of 2012, looking at this picture of the precasted Dow price path through May of 2013. To me, the obvious indication would be to buy low and sell high. So we have a buy point established and a sell point on 7/10 of 2012. And here we are a few months later on May 6th of 2013. We bought at the buy point and sold at the sell point. So here's our plan. Here's our execution. Plan and execution. Is it possible we're disrupting risk management as a premise? I have to ask exactly what risk management tools or decisions would have been useful or even needed here in this example. Let's look at some actual trade results of trading the Baradine signal. A disruptive technology necessitates disruptive thinking, and disruptive action. Disruptive premise 1 in Baradine, trust the precasted price signal. Disruptive premise 2 in Baradine, trade the signal exactly on the group recommended dates, entry and exit. Disruptive premise 3, not for everyone, ignore risk management. In other words, use risk management at your own risk of losing your profits. Replace risk management with prudent and intelligent position sizing based on your own personal risk tolerances. A very simple way of trading. One Baradine trader used all this disruptive thinking and actions in now documented live trades from April of 2013, after taking 2 months or so to build his own confidence in the Baradine signal in the live meetings online from February of 2013. Here are his actual personal trade records for the year of 2013 through February 1st of 2014, which he has generously agreed to allow us to make public here, 1 full year of planning and then trading. His profit performance on his actual initial $100,000 Baradine portfolio was $72,838.31 net of costs. 1 year of applying this disruptive thinking and technology paid him very well. He is still actively trading the same disruptive way today and attends every online traders meeting. Prior to joining Baradine, Jerry was not an active trader. This is a listing of Jerry's actual trades and the trade dates initiated per Baradine recommendation and the profits and losses. Total profit $72,838.31 net of losses and costs for less than a year of trading the Baradine signal. Let's take a look at the summary. It's easier to see this way, I think. The net profit $72,838.31. Number of trades 77. The average trade length was 18 calendar days. Number of winners was 47. Number of losers was 30. Percentage of winners was 59%. The maximum winner was $12,806.12. The maximum loser was $7,665.48. The average winner overall was $57.92.64. The average loser was $19.84. The smallest winner was $348, and the smallest loser was $96. His average win-loss profit ratio, comparing the average win to the average loss, was almost 3 to 1. Jerry uses no stops, trusting the entry date and exit date as signal defined. Was there drawdown? Of course. But this is the results. 73 average profit return for 1 year from 2013 to 2014. I would note, not enough drawdown to get him kicked out of his futures trades. These are the Baradine original assets that we have a price catalog on, continue to update. These are indexes and fixed income we've now cataloged. These are stocks and ETFs we've now cataloged. These are styles and precious metals that we've now cataloged. And these are the sectors we have now cataloged. But when we get down to it, as they say, it's all about the Benjamins. Let's look at hedge fund returns. just highlighting this article from Bloomberg. Hedge funds trail the Standard & Poor's 500 index for the 5th straight year. Hedge funds returned an average of 7.4% for the whole year of 2013. Funds lagged behind the S&P 500 stellar performance by 23 percentage points last year, the most since 2005, as the U.S. benchmark surged 30% for its best performance since 1997. Hedge funds fell short of investor expectations as clients targeted net returns of 9.2%, according to a Goldman Sachs group, which most of you only are expecting to get 9.2% out of your trades. Stocks rallied last year amidst gains in consumer confidence and a housing rebound. The explanation was that hedge funds are always going to underperform the S&P in a year like this because hedge fund managers, if they're doing what they should be doing, are hedging. Anyone who's had any kind of short position last year had bad performance. Let's take a look at the S&P 500 returns for 2013 from Wikipedia. Last year, 2013, total annual return, including dividends, was 32.39%. But as we look down the scale, the 5-year returns were 17, 10-year returns were 7.4, 15-year returns were 4.68, 20-year returns were 9.22, and the 25-year annualized return was 10.27%. The historic high for returns for the S&P was 37.58. Historic low was almost identical, minus 37.5, 37%. The compounded annual growth, the S&P, is calculated at 10.4. Bond returns, okay. Bond returns of various asset classes, you can just see the highlighted figures. They vary from 2 to -1 to -9 to -3, -5, +7 to a high at 12.48% on long-term U.S. Treasuries, the Barclays U.S. Government Long Index. Let's look back at Jerry's trades. Net profit, to remind you, was $72,838.31, which is a 73% annual profit return for 1 year from 2013 into February, essentially the S&P year of 2013. In other words, Jerry's trades, driven by Baradine's signal, outperformed the S&P in a near record year by 225%. This is a fact. It is documented. It happened. It will continue to happen. Premise 3, I don't think needs much disruption, but I brought it up here. I thought it was interesting, is that you can resist an invading army, but you cannot resist an idea whose time has come. Attributed to Victor Hugo. What are the Baradine trade results? Jerry didn't take every Baradine trade, but over 418 calendar days, the Baradine trade results produced 164.39 total net percent profit sum. In other words, if you added together each individual 169 trades return percentage-wise, the good, the bad, and the ugly, there was a net percentage in the column in the sum of 164.39%. All these trade recommendations have been documented by live time-stamped recorded WebEx meetings in front of anywhere from 10 to 15 witnesses for the last year and a half, and twice weekly posted Excel spreadsheets in Baradine's private Yahoo group. What's the opportunity? Well, potentially trading with no stops, no technicals, no risk management, a very simplified graphic visual entry, exit trade dates based only on the precasted price line, and the predicted planetary rate of change signal levels. Group trade decisions to help are live twice weekly as the signal unfolds in front of us. If any asset price can be known in advance, well, the trading benefit opportunity should be self-evident. We invite you to consider joining Baradine. The Paradigm Traders Global Group meets twice weekly in live online WebEx sessions, Mondays and Thursdays at 4:30 p.m. Eastern USA Time. All meetings have been recorded and are available for documentation and later review. We also host a once weekly early adopter Paradigm Trader training live online discussion forum with recorded meetings on Thursdays at 3:30 p.m. Pacific USA Time. Paradigm Trades are emailed twice weekly after each meeting with exact entry-exit dates, and amends are made if necessary to the trade dates per the live meetings for the official Paradigm trade recommendations on the original 15 Paradigm assets. During the meeting, we also discuss trades on the earlier mentioned other price catalogs, but the Paradigm trades are still officially these 15 assets you see here. The Paradigm Yahoo Group has all 50 plus assets cataloged, and the worksheets and graphs and the data are available for download and study and member-driven commentary postings. Email and inquiries to Paradigm@cycles.cc. All contents have been copyrighted by FSC 2014. All rights reserved. Paradigm is a registered trademark of the FSC L3C. Thank you for your time, and watch for the next video magazine a week from today. Best trades.